Welcome back to Investing Talk Podcast.
Great to be here.
Today, we're tackling a question that seems to be on a lot of people's minds, and one you specifically asked us about. Is Gartner a good time to buy now?
Yeah, it's seen quite a dip recently, hasn't it?
It really has. So we're going to unpack the latest info, the analysis, try and give you the full picture. Think of it like a bit of financial detective work. Is this sharp drop just a temporary blip for a market leader? Maybe a rare buying opportunity.
Or, are there maybe deeper issues starting to surface that the market's just now pricing in? That's the key question.
Exactly. And this analysis, it's custom, based on sources provided just for you or a listener, kind of a shortcut to getting up to speed. So before we jump in, if you find this useful, please do hit that subscribe button, give us a like, maybe leave a comment with your thoughts.
Yeah, definitely let us know what you think.
And if there's another company you'd like us to look into, just drop it in the comments. And you can always support the show. Maybe buy us a coffee if you feel like it.
We appreciate that.
Okay, let's get into it. We're focusing on Gartner today. Now, most people know them, right? Global leader in IT research and advisory.
Right.
But maybe break down their core business for us. Why is it considered so strong?
Well, what's really fascinating here is Gartner's fundamental business model. It's not just selling reports, It's built on these high-value, deeply embedded subscription services.
Embedded how?
Well, think about it. A company integrates Gartner's research, their frameworks, into critical C-suite decisions, IT strategy, vendor selection, digital transformation.
Right, the big stuff.
Exactly. And the institutional knowledge, the operational dependence that builds up around Gartner, it creates these massive switching costs. It's not just the subscription fee.
It's disrupting their whole workflow if they leave.
Precisely. It disrupts deeply embedded processes and makes Gartner almost indispensable once they're integrated. That's the moat.
So clients really get locked in a way. And the numbers, well, they really tell a story there, don't they?
They do.
If you look at the fundamentals, Gartner reported 2024 revenue, $6.27 billion. That's up a solid 6.1% year over year.
Which is decent growth.
But the net income, wow, it surged to $1.27 billion. That's a, 42.1% increase?
Yeah, that's huge.
The sources point to substantial operating leverage, which makes sense for a research business, right? Once the research is done.
Exactly. The cost to add another subscriber is pretty low. So as revenue grows, a big chunk drops straight to the bottom line. It supercharges profitability much faster than, say, a manufacturing company.
Makes sense. So what about looking for what's their own guidance for 2025?
Okay, so Gartner themselves guided for fiscal 25. They're projecting about $6.5 billion in revenue and $11.75 in earnings per share, or EPS.
So still growing, but maybe the pace is moderating slightly.
That's how it looks, yeah.
Continued but moderating growth seems to be the message from them. Steady trajectory.
Okay, but here's where it gets interesting, digging into the analyst view. Because Gartner's guidance is one thing, but what's the broader street saying for 25? Is it different? It is, slightly. The analyst consensus is actually a bit higher on average, forecasting $6.8 billion in revenue and $12.84 in EPS for 2025.
Higher revenue, higher EPS. Sounds good.
Well, here's the nuance the sources highlight. The consensus also suggests that 2025 is expected to see a modest EPS decline before resuming growth thereafter.
Wait, hang on. Higher average revenue forecast, but an expected decline in EPS for that year. How did that square? That seems contradictory for you, the listener.
It does seem odd at first glance, right? But it highlights the market's focus on profitability per share. The sources suggest that while revenue might grow, there could be shifts in Gartner's cost structure, maybe investments planned for 2025, that slightly dampen the earnings per share just for that year.
Ah, okay. So higher overall profit maybe, but spread over potentially more shares or offset by costs, leading to slightly lower EPS temporarily.
Something like that. It's seen as more of a short-term blip in the EPS expectation, not necessarily a crack in the actual revenue growth story itself. It's that kind of nuance we're trying to unpack for you.
Got it. So connecting that to their financial health, do they have the muscle to handle these kinds of short-term earnings fluctuations?
Oh, absolutely. Their liquidity looks pretty robust. Their trailing 12-month EBITDA, basically cash earnings from operations before interest, taxes, etc., it's well over $1 billion.
It's a lot of cash flow.
Yeah, and it's paired with consistently strong free cash flow. Plus, they maintain moderate debt levels relative to those earnings, and their balance sheet looks quite healthy.
So they have a buffer.
A significant buffer, yeah. It helps them weather market volatility and manage these short-term dips without too much stress.
And it's also worth noting Gartner doesn't pay a dividend, right?
Correct. The analysis suggests management prefers to reinvest earnings back into the business or use cash for share repurchases.
Which can boost shareholder value in a different way by reducing the share count over time.
Exactly. Now, digging a bit deeper into their competitive edge, Gartner is just really entrenched.
Oh.
Those deep sector relationships, that huge established customer base, they create really significant barriers for anyone trying to compete. And the mission-critical nature of their insights.
Meaning companies need their advice for big decisions.
Right. That makes the core business relatively recession-resistant. Even when budgets tighten, companies often still need that reliable intel to navigate tricky times. It's a powerful differentiator.
But it's not just the core research, is it? The sources mention conference and consulting segments too.
That's right. They do offer some diversification. But as the analysis points out, those segments tend to be more cyclical in nature.
So more sensitive to the overall economy compared to the sticky subscription stuff.
Exactly. They contribute, but their performance might swing more with broader economic cycles.
Okay, so we've looked at the business, its strengths, the financials. Seems pretty solid fundamentally. But, the market price tells a different story recently. So how is Wall Street valuing Gartner right now, especially after that turbulence?
Right. Let's break down the valuation. Gartner's trailing PE ratio, price to earnings over the last year, is about 15.2. The forward PE, based on expected earnings, is around 19.9.
And price to sales?
Price to sales is roughly 2.9. Now, generally, these metrics look pretty attractive for a high-quality, asset-light business like Gartner.
Attractive how? Compared to what?
Well, what's really notable is that the PE ratio is currently below its historical sector average. The sources suggest this is partly due to that recent stock price decline, so it might be trading at a discount compared to where it usually sits.
Okay, a potential discount. And that leads us right into the analyst price targets, which, they paint quite a picture.
They really do. The consensus 12-month price targets, they range from around 346 sensors, which is, about 42% upside from the current price of roughly $242.
So it's all the way up to $474.50. It's a potential increase of 94.5%.
Wow, nearly double. That's a huge range and a massive potential upside. Why such optimism or such a disparity, especially given they just lowered guidance? Yeah, it's a fair question. While the sources didn't provide specific DCF models, the general feeling seems to be that based on Gartner's fundamentals and even their near-term guidance, the risk versus reward looks pretty favorable right now.
Even with conservative growth assumptions.
Apparently so. That significant potential upside highlighted by analysts suggests a strong belief that the stock could recover substantially, that the current price is seen as a temporary undervaluation.
Okay, let's shift gears slightly to the technical picture. Charts and trends. That can tell us about short-term sentiment, right?
Absolutely.
So Gartner's trading around $241, $242 right now. And as we mentioned, that's way down from its 52-week high of $584. And crucially, it's very near its 52-week low of $231.
Yeah, that's a dramatic drop. And technically, this suggests the stock is, deeply oversold.
Oversold meaning it's fallen too far too fast.
Pretty much. The analysis points to strong technical support down here around the $230 to $240 level. And the RSI, the relative strength index, that momentum indicator, it's also reportedly deeply oversold.
Which often signals a potential bounce, right?
It can, yeah. Now, volatility is definitely high after the downgrades and heavy selling. But these technical setups could favor what's called mean reversion, basically, snapping back towards the average in the short term, assuming, the fundamental story holds up.
Okay, stepping back again, what specifically caused all this recent selling pressure and cautious sentiment?
The main trigger, according to the sources, was definitely Gartner lowering its fiscal year 2025 EPS guidance.
That's specific news.
Yes. That announcement led to really large volume selling and, predictably, a wave of analysts cutting their price targets. The analysis mentioned Morgan Stanley, for example, trimming their target from $490 down to $455 right after the news.
So a classic market reaction to revised forward earnings.
Exactly, especially impacting the bottom line like that.
But importantly, we need to balance that immediate reaction, right? Despite those cuts and the stock drop, what's the overall analyst consensus now?
That's key. The overall consensus rating actually remains buy. And the mean target price is still up there in that 425 to $474 range we talked about.
So even with the guidance cut, most analysts still see significant long-term value. That's quite a signal, isn't it?
It is. It suggests they're looking past the immediate adjustment to the underlying strength. In terms of insider activity, sources report no major buying or selling recently.
It means.
Well, it's neither a strong vote of confidence nor a major red flag from the insiders. Kind of neutral. Overall sentiment, across forums, media, analyst notes, it's described as cautious but leaning positive.
Why positive given the drop?
Mostly because of that depressed valuation we discussed, combined with Gartner's solid track record of execution. It seems people are weighing the guidance cut against the fundamental strength and seeing potential value, much like the picture we've been building for you.
Okay, so given all that context, what could actually move the needle for Gartner next? What are the potential catalysts?
Right, looking ahead. Short term, the next earnings report is in August 2025. That's one to watch, although, the recent guidance might limit any big upside surprise there.
So maybe less about earnings beat, more about.
More about that potential oversold recovery or a short-term technical bounce we mentioned. If the market feels the bad news is fully baked in, you could see buyers step in just based on the chart.
And longer-term catalysts.
Several possibilities. A broad recovery in IT spending cycles would be huge for them. As companies invest more in tech,
They need more Gartner insights.
exactly. Continued expansion of their subscription services, new areas, deeper penetration that builds on their sticky customer base, and then potentially bolt-on acquisitions, smaller strategic buys, or maybe more share buybacks could also boost the stock.
Makes sense.
Yeah.
But we absolutely have to consider the flip side. What are the key risks here?
Crucially, yes, you have to weigh the risk and sort of group them. Stock-specific risks first. Gartner is still vulnerable to further downgrades. If growth post-2025 slows more than expected, or if future guidance disappoints again.
The market could react negatively again.
Swiftly, yeah, just like we saw. And their dependence on the IT sector spending environment is real. While they're seen as resilient, a really severe or long downturn in enterprise IT budgets would eventually bite, potentially impacting renewals, not just new sales.
Okay, those are company specific. What about broader market or sector risks?
Well, general macroeconomic weakness is always a risk. If companies everywhere tighten belts significantly, those discretionary budgets for external advice, even Gartner's, could get cut. That would hit subscriptions, but especially the more cyclical conference and consulting parts.
And competition.
Yeah, increased competition is always out there, maybe from smaller, specialized boutique consultancies, or even large companies trying to build more internal expertise to save costs. That could chip away at Gartner's market share over the long run if they don't keep innovating and proving their value.
Okay, so quite a bit to consider there on the risk side too. So let's try and bring this all together for you, our listener. What's the overall investment thesis summary based on the sources we've looked at today?
Right, so the overall rating derived from this analysis comes out as a 7.5 out of 10.
7.5 out of 10. And the reasoning.
The rationale provided is basically that Gartner presents an attractive risk-reward profile at its current price level. This is based on those strong fundamentals we discussed, clear competitive advantages, and a valuation that looks, depressed compared to its history.
Then the downside risk.
Seen as somewhat limited by the company's strong cash flow and its leadership position in the sector, plus those technical factors suggesting the stock is oversold, and the fact that most analysts still have pretty high price targets.
Okay. And what about the investment horizon? Is this seen as a short-term play or a long-term hold?
The sources suggest it could be suitable for both, actually. Short-term trading, looking for that potential oversold bounce we talked about, and also long-term investment based on the core business strength and that margin resilience.
Right. And did the analysis provide any specific price levels to consider?
It did. For those thinking about entry, the suggested price range from the analysis between $235 and $245.
Okay. Right around where it is now, basically.
Pretty much. For trading specifically, a stop loss was suggested at $225, and potential take-profit targets were mentioned between $280 and $300.
Got it. So those are concrete parameters from the analysis for you to consider in your own decision-making.
Exactly. They're derived from the source analysis.
So here's a final thought maybe for you, the learner, to chew on. Does Gartner's current situation look like just a temporary stumble for a fundamentally strong long-term leader? Is this a genuine buying opportunity created by short-term noise?
Oh, or perhaps are these near-term headwinds, the slowing growth, the guidance cut, actually more significant than the market is fully appreciating? even at these lower prices.
Mm.
Does that suggest maybe more caution is needed?
That's the question to ponder, isn't it? Weighing the fundamental strength against the current sentiment and outlook.
Mm-hmm.
We really hope this unpacking of Gartner has given you a clearer picture and some valuable insights.
Hope it helps.
Remember to subscribe, like, and comment. It really helps support the show and lets us know what you think.
Yeah, we love hearing from you.
And if you found this valuable, consider buying us that coffee. And definitely let us know in the comments if there's another company you'd like us to analyze next time.
Please do.
Thanks so much for tuning in, and we'll catch you on the next one.